key here. And stable pricing is they've defined that as a 2% inflation target rate. Where that comes from, there's a lot of speculation about that, and about the expansion of the gold supply back in the 70s to I believe it was the Australian central bank. In fact, I'm going to say it's either Australia or New Zealand. I can't remember off the top of my head this morning. This is my first call, but they had determined that that's the rate they were going to pin the inflation rate to, their target. And the Fed, kind of uses that, and they've been using it all along. So even the earlier this year, like back in February, I believe, Powell was on 60 Minutes. And he was asked, why 2% inflation? And he gave some word salad answer that had nothing to do with the inflation rate. But it had more to do with the target, the terminal rate of the treasuries. And the reason he didn't have a real answer for that, and he went into word salad diatribe, was that there is no reason. There's no reason for a 2% inflation except for one. And that reason is because they need expansion of the money supply. And why do they need expansion of the money supply? They need expansion of the money supply because of the expansion of the debt. Employment rate, it's stable. But the reason we believe that the influx of, many millions of immigrants they've affected that rate. And so when you have, 5, 10, 15, 20 million immigrants, who knows how many there really are, somewhere between 10 and 20 million immigrants come into this country, then unemployment will go up.
Because the labor supply goes up.
Yeah, exactly. So, but it's an increase in labor supply rather than a decrease in available jobs. And that's a big deal. Okay, so now you've got this big mess. We've got unemployment is kind of rising, but some of it is due to the influx of participants, like you said, but inflation is kind of stuck at 2.5%. Why? So, and why would they be lowering rates now? The simple answer is because the last thing that the Fed and the Treasury want is to destabilize the Treasury market by having a deflationary event. I mean, if we have a spike in unemployment, we have mass layoffs, the stock market sells off, companies are making less money, they're laying people off, their GDP goes down, and there's just not as much money to buy U.S. Treasuries. That's a problem. Why is that a problem? Well, the problem is because we're running massive deficits. Concerned about the Treasury market. Well, what do I mean by that? Well, and he uses the QE and QT. Okay, so let's go back to 2008. When you saw the influx of massive QE when we went into the great financial crisis. Quantitative easing, meaning money printing. The Fed literally just prints money and goes into the open market using the bank institutions, the primary dealers, to go into the market and buy treasuries for them and put them on the Fed's balance sheet. And that stabilizes the market. They literally just print money. It's like putting extra money into the monopoly board and then going and buying a bunch of stuff with it just to get keep everything going. And the problem with that is that, that conditions the market, right? So now you go flash forward to 2020 and you saw a massive QE. Okay. We saw massive QE because that drawdown in the market, because we had lockdowns and people freaked out. Rightly so, that the economy was going to grind to a halt. Rightly so, because it did, and then they poured, on somebody to make those payments. So they needed more cash. Okay, so there's another demand for cash. And the third thing was overseas with the dollar. The central banks and investors overseas had a lower demand for treasuries, because they couldn't afford them as much as they normally could. So those three things put together ended up having, it ground the Treasury. Basically, what it did was it spiked the overnight rate, meaning there wasn't enough dollars. There was a dollar shortage, basically. And so when the Treasury was going to go out and do their normal, now raised refunding, elevated refunding, They were concerned there wasn't going to be enough dollars out there, and they were going to have a dysfunction in the bond market. Would they have a failed treasury auction? Not likely, but they could have something pretty ugly. And so instead of having that, they turned around and started QE. So if you pull up Fred and Fed assets, you'll see there's a great there. You can see exactly how the Fed has grown their balance sheet through QE through this time over the last number of years. Since 2008, you'll see it really rise up development on. So now you're at over $5 trillion. Let's call it 5.1 trillion. Then you have, that's 5.1 trillion right there. So you're already overspending between your mandatory expenses and your defense. And then you haven't even talked about your interest on your debt, which you absolutely must. You must pay the interest on your debt or else you default. And if you default, then your bonds get downgraded and your currency hyperdeflates because nobody believes in it anymore, and nobody's going to hold your bonds anymore. Nobody's going to allow you to borrow money from them anymore. And so the interest on our debt is over $1 trillion annually now. Okay, so let's call it the net interest, meaning that they're intergovernment agencies that are borrowing from each other. The net interest is about $900 billion. But you're at $6 trillion of expenses. Then that's before you have any of your discretionary expenses of almost $1 trillion, 900 something billion dollars. So your deficit is now $2 trillion. Well, how do you deal with that? Like, how do you deal with that deficit? You've got three choices. You can, with the US Treasuries and the global reserve currency with the dollar. And it's really because the dollar that we have the global reserve treasury, the asset of the treasuries, because people buy treasuries to get interest and then turn them into dollars later. So the important thing here is that this is all the United States, as bad as it is the cleanest shirt in a pile of dirty laundry, as my friend Greg Foss likes to say. And he uses some other colorful analogy. But we won't use those here. But the point is that this can take a very long time. There is no way out of it. As another friend of mine, Lynn Alden, likes to say, nothing stops this train. And what does it all mean? So why do we care? Why do we care about all of this? Like, why are we talking about this? What does it matter? Well, it matters because they're spending so much money that they have absolutely no choice, because they're not going to cut expenses. They're not going to raise taxes. They're just going to keep issuing debt. And so it matters because they're going to keep expanding the money supply, which means that they're going to keep instituting inflation. So this all comes to that. If it's over, if it's 5.5% is really contractionary, right? Restrictive. If it is the word that you really we're looking for here, is if 5.5% is really restrictive and they're trying to get back to 3.5%, well, why is inflation stuck at 3.5%? Okay, there's a few reasons. Number one, we have massive spending coming out of Congress, out of DC. That spending is inflationary. They're spending money, they're just creating dollars to spend money, and you can see the money supply is expanding now. You can pull up M2 and it's expanding, but they're pouring money into the economy, and the majority of jobs that have been created over the last 18 months were from the government. They're not private. So that tells you that spending out of the government is keeping the economy going. Is it fake? It's not fake because it's real, real dollars going into the economy and people use those in the service sectors, but it's not as productive. The government isn't spending money that's on productive projects and productive, businesses. That's private industry that's doing that. Those are the Elon Musks and Tesla and all that. They're place that's done it well is France. They've invested in nuclear energy, and you could see the productivity per citizen skyrocket. The exact opposite is happening in Germany, right? So productivity per citizen is is tumbling, and it's because they're shutting down their nuclear plants. They're having to buy energy from Russia at high cost. They don't have the right facilities to create their own energy. They're not oil independent, and so that's a problem. You're going to see, and so how do they deal with that problem? Just print more money. So the problems in Europe are far greater than France can help with, and so you're going to see though that continue devalue of currencies around the world, and they just dump into the dollar, and they're going to be looking for things to do, and it would help them, but I don't think they're going to get there in time. Personally, I just don't think they're going to get there in time. So could it be helpful? Absolutely. I mean, it's the world's hardest money. If you stop, pull back, and think about it, the only difference is that the US dollar has everybody using it and believing in it. Well, that belief will stop at some point. At some point, that will stop. I don't know when, and it'll be the last or one of the last currencies to fail. But with the rate we're going, even the Treasury itself says